In 1978, a factory worker in Michigan retired at 55, with no mortgage, no car payment, and no credit card balance, on a salary that never crossed $18,000 a year. His neighbor, same job, same paycheck, retired at 68, still paying off a truck. The gap was not income. It was 20 rules his father drilled into him before he ever cashed his first check. Number 14 got quietly phased out by banks in the 1980s because it cost them billions in interest they were counting on. Number 1 is the rule almost nobody follows anymore, and it explains almost everything else on this list. Before we start, hit subscribe, because being debt-free was never about luck. Number 20. Never financing anything that loses value the moment you own it. A rule as old as installment buying itself. Furniture, electronics, clothing, none of it belongs on a payment plan, because by the time the last payment clears, the thing you financed is worth a fraction of what you owed on it. Families who stayed debt-free paid cash for depreciating goods or waited until they could, treating any store offer of easy monthly payments on a couch or a television as a warning sign rather than a convenience. Number 19. Paying the credit card. In full every single month, no exceptions. Before the modern minimum payment became normalized in the 1970s, many households that used charge cards treated the monthly statement the way they treated the rent due in full, on time, without negotiation. $1 carried over accrued interest that erased any reward or convenience the card offered. The households that stayed debt-free were not people who avoided credit entirely. They were people who never once let a balance survive past the due date. Number 18. Buying the car that is 3 years old instead of new. A new car loses roughly 20% of its value in the first year alone, and financing that loss over 5 years at interest compounds the mistake twice. Debt-free households let someone else absorb that first drop, buying a well-maintained 3-year-old vehicle for a fraction of the sticker price and driving it another decade. The difference between a new car payment and a used car paid in cash, invested instead, is one of the most consistent predictors of who retires without debt and who does not. Number 17. Treating a raise as invisible. When income increased, the debt-free household kept spending flat and redirected the difference to savings or debt payoff before it ever touched the checking account. This habit fought directly against a pattern psychologists call lifestyle creep, where spending rises to match income almost automatically. A raise that never changes your spending is a raise that compounds. A raise that upgrades your car and your apartment is a raise that vanished the day it arrived. Number 16. Keeping a separate account that nobody touches for anything but emergencies. Before high-yield savings accounts existed, this often meant an actual envelope or a passbook account at a separate bank specifically chosen to be inconvenient to access. The inconvenience was the point. A reserve that takes 3 days and a drive across town to reach survives an impulse. A reserve sitting in the same account as the debit card does not. Households with this habit could absorb a job loss or a broken transmission without reaching for a credit card, which is the single most common way an otherwise debt-free household ends up back in debt. Number 15. Refusing store credit cards regardless of the discount offered. Retail credit cards routinely carry among the highest interest rates in consumer lending, often well above 20%, disguised behind an opening discount of 10 or 15% on today's purchase. Debt-free households calculated the math once, realized the discount rarely outweighed even a single missed payment cycle, and declined the offer at the register every time, no matter how the cashier phrased it. Number 14. Choosing a fixed-rate loan over an adjustable one whenever a major purchase required financing. Adjustable-rate products became common in the 1980s, specifically because they let lenders shift risk onto the borrower, offering a lower rate at first that could rise sharply later. Households that stayed debt-free treated predictability as worth paying for, choosing the fixed rate even when it started slightly higher, because they were optimizing for the worst year of the loan, not the best one. Number 13. Never borrowing to invest in anything with an uncertain outcome. Margin loans, business loans without a proven customer base, and borrowed money for speculative ventures shared one trait in debt-free households. They were avoided almost entirely. The rule was simple. Debt used to buy an asset with a predictable, modest return, like a home within your means, was acceptable. Debt used to chase an uncertain upside was treated as gambling with a guaranteed downside, because the interest was owed regardless of whether the bet paid off. First pattern break. Everything so far has been about avoiding the debt that traps people. What comes next is different. These are the habits that actively built the cushion that made staying debt-free possible in the first place. And this is where the gap between the households that made it and the households that did not really opens up. Number 12. Automating savings before the paycheck ever reached a checking account. Payroll deduction into a retirement or savings account, sometimes called paying yourself first, removed the decision entirely. Money that never touched a spendable account could not be spent. Households that treated this as non-negotiable, arranging it the same week they started a new job, built savings without ever consciously choosing to sacrifice anything, because the sacrifice happened automatically before it could be felt. Number 11. Buying a house they could afford on one income, even when two incomes were available. This rule sounds almost extreme today, but it functioned as insurance. A household whose mortgage payment fit inside a single salary could absorb a layoff, an illness, or a maternity leave without missing a payment. Households that stretched to the maximum a lender approved based on two incomes had no such buffer, and a single job loss often triggered the exact debt spiral the rule was designed to prevent. Number 10. Negotiating every major bill instead of accepting the first number. Insurance premiums, medical bills, even interest rates on existing loans were treated as starting offers, not final prices. A phone call asking for a lower rate or a payment plan without interest succeeded far more often than most people assumed, simply because most people never asked. Debt-free households treated the sticker price on any bill above a certain size as a negotiation opener, and the savings, small individually, added up to real money kept out of debt every year. Number 9. Waiting 24 hours before any purchase above a set dollar threshold. This was not a productivity hack invented by a personal finance blogger. Households that stayed debt-free for generations practiced a version of this long before it had a name, sleeping on any purchase large enough to matter and often losing the impulse entirely by morning. The rule filtered out the purchases driven by a bad day or a clever advertisement, leaving only the ones the household still wanted after a full day of thinking about it. Number 8. Carrying only one credit card instead of several. Multiple cards made it easy to lose track of total balances across statements, and each new card came with its own due date, its own minimum, and its own chance for a missed payment to trigger a penalty rate. Debt-free households consolidated their credit use onto a single card, specifically to make the total owed impossible to lose track of, treating simplicity itself as a form of financial discipline. Second pattern break. Here is something the personal finance industry tends to leave out of the story. Staying debt-free was almost never about a single dramatic decision. Nobody avoided a lifetime of debt by winning the lottery of financial willpower once. It was a set of small, boring, repeated behaviors practiced so consistently they stopped requiring effort. The next several rules are where those small behaviors turned into an entirely different financial trajectory than everyone else their age. Number 7. Reviewing every bank and credit statement line by line, every single month. Before automated bill pay made reviewing statements optional, checking every charge against every receipt was standard practice, not a chore reserved for the meticulous. This habit caught billing errors, forgotten subscriptions, and creeping fees before they became permanent expenses. Households that stopped reviewing statements once autopay became convenient consistently reported paying for services they had forgotten they still had, sometimes for years. Number 6. Treating insurance as debt prevention rather than an expense to minimize. Adequate health, disability, and property insurance existed specifically to prevent a single bad event from forcing a household into debt. Underinsuring to save a small premium each month was, statistically, one of the most common paths from debt-free to deeply indebted, because a single uncovered medical bill or an underinsured house fire could erase a decade of careful saving in a single event. Number 5. Never co-signing a loan for anyone, including close family. A co-signed loan is a full legal obligation, not a favor with no downside, and debt-free households treated it accordingly. If the primary borrower missed a single payment, the co-signer's credit and finances were affected exactly as if they had taken out the loan themselves. Households that stayed debt-free had, almost without exception, a firm and consistently enforced rule against this, regardless of the relationship or the guilt involved in saying no. Number 4. Choosing the shorter loan term even when the payment was higher. A 15-year mortgage instead of a 30-year one, or a 3-year car loan instead of a 6-year one, meant a larger monthly payment, but dramatically less interest paid over the life of the loan, and a much shorter window during which a job loss or emergency could turn a manageable debt into an unmanageable one. Debt-free households consistently chose the shorter term and adjusted their spending elsewhere to make the higher payment fit, understanding that time was the single biggest cost driver in any loan. Number 3. Tracking net worth once a year, regardless of how uncomfortable the number was. This meant adding up every asset and subtracting every debt in writing every year, whether the number was improving or not. Households that avoided this exercise, because the number felt discouraging, tended to drift slowly into debt without noticing, because no single month felt alarming on its own. Households that faced the number annually caught the drift early and corrected course before it became a crisis. Number 2, spending time, not just money, learning how loans actually work before signing one. The debt-free household understood amortization schedules, the real cost of compounding interest, and the difference between APR and a monthly payment before they ever sat across from a loan officer. This was rarely formal education. It was often a parent walking a young adult through an actual mortgage document line by line at the kitchen table. Households that skipped this step signed whatever was placed in front of them and frequently paid for that ignorance for decades. Number 1, and this is the rule underneath every other rule on this list, deciding in advance what debt-free actually meant to them and refusing to redefine it under pressure. Every household that stayed debt-free had, at some point, drawn a clear line, sometimes written down, sometimes just understood, about what kinds of debt they would accept. A mortgage, perhaps, and nothing else. And then held that line, even when a salesman, a friend, or their own impatience argued for an exception. Households that struggled with debt rarely lacked the knowledge on this list. They simply redefined their own rule every time a new temptation made an exception feel reasonable, one exception at a time, until the rule no longer existed. Every habit here points back to that same idea. Staying debt-free was never about earning more than everyone else your age. It was about deciding, early and specifically, which financial risks were worth taking and which ones were not, and then refusing to negotiate with yourself when the moment came to break that decision. The factory worker in Michigan did not have a special income. He had a rule he never bent. The question is not whether you understand these 20 rules. Most people do, at least in theory. The question is whether you would hold to a single one of them the next time your own excuse showed up sounding reasonable. Pick one from this list and hold it for 90 days. Then come back and tell me which rule was hardest to keep, because that is usually the one that matters most.